Hi class. This video is made during our unprecedented 2-week spring break. So for most of my classes, we have a 2-week spring break, and the week you return, which is the first week in April, we're going to have our midterms for our classes, and then the following week, lectures are going to resume. And on Blackboard, they added a new Zoom conferencing menu button. So when classes start up again in April, I'm going to include, and you can see this on announcements, I'll list the dates and times in the announcements, where I'll be holding live video conference classes. So this is something that you can connect into me live via Zoom communication, and if your laptop or computer has a microphone and camera, you can communicate with me and we can talk about the current events, what's happening in the class, homework assignments, future exams, and course topics. So look forward to that in April, and I will make the announcement towards the end of spring break on Blackboard. I'll make the announcement there and also send the emails out. Some of you may have questions, since you're finance students, about the market. Now, before you watch this video, you may want to go back to my channel and watch my video I made 2 years ago called Will the Stock Market Crash in 2020? So this video I presented at an alumni function a couple of years ago and talked about why stocks rose so much in 2017, 2018, and then the possibility of a crash or what could happen in a crash situation and what you could do in that situation. So you may want to go back, watch that video. A very informational video. It's definitely a must watch for any of my finance students. And if you haven't already done so, please subscribe to my channel, because I will be posting course content here as well as other informational videos. If we go back to the market, so we had a very nice run up here. If we go back, let's go back 5 years. So we're going back 5 years. This is sort of Trump's elected. The Dow is 16,000. During Trump's presidency, the Dow goes all the way up to 29,300, or almost 29,400. So a very impressive run on the Dow. Now, for me, whenever the Dow breaks, and this is covered in technical support in my investment classes, but back here, the Dow broke the 50 and 100 day. So the red line is the 50-day moving average, which is just 50 days of stock prices divided by 50. And the green is the 100, that's the 100-day moving average. So I could also set up, this is Google Charts, by the way, I might want to set up a 200-day. And we'll make the color of that, I think I'm using red, green, we'll make that like a, let's see, red. Oh, I guess we could leave it purple. All right, I'll leave that purple. Okay, so here is the 5-year chart of the Dow. Now, if the Dow, the 50-day moving average is usually when the Dow breaks that's going to be a downward trend. And if it breaks the 100-day, that's definitely two indicators the Dow is going lower. And then we see here a lot of turmoil here in around 2016, and this involves the presidency and the election, and the markets were really kind of worrisome here because people weren't sure what was going to happen, who was going to be elected. But once the election cleared up, the Dow rose quickly above the 50-day and the 100-day, and just pretty much stayed above that all the way into 2019. And we had a period where the Dow was testing the support of the 50-day and then broke up through the 100-day. So that was a correction we had, a market correction there. Then since that, the Dow has been trending above the 50, 100, and 200-day. And that's pretty significant. So this just means the normal bull market trading pattern that we have here. Now the problem comes, let me shrink this down to a 2-year. The problem comes here, where the Dow breaks the 50-day. So technically saying that would be your first sell sign. It breaks the 100-day, your second sell sign. And when it broke the 200-day, that would be your third sell sign. And we can see that the Dow ended up at 20,000. And, quite possibly, I think that the Dow, given the situation with, we're worried about possible recession being created from the quarantine related to the pandemic. And this is what traders are really fearful of. So they're overselling the market. And typically, and you can see here in this RSI indicator, which is relative strength, usually that trades around 50. When it gets up to over 70, they usually say to sell the market. And you can see this is over close to 70. And then when it gets below 20, it's at 21 right now, you should buy the market. So that's just another technical indicator. However, with this particular market, I lived through a number of bad stock markets. 1987, 1991. There was a brief hysteria for currency crisis, and I think it was 97 or 98. 2000, 2003, 2008, and of course today. So I've been through a number of these market correction crashes. Now, each of them are sort of different in their own way, and they have their own different characteristics. So the 1987 stock market crash was a 25% decline in one day. But what was odd about that was there was really no recession around that crash to the stock market. So for a couple of years after that, it took until about 1990 before a recession developed. So that stock market crash was really just a valuation issue. There's some computerized, basically it was sort of like a mini panic was created during that recession, and it fed on itself and drove the stock market lower, which the market came back relatively quickly that year once people realized the underlying cause wasn't really economic. And these crashes that happened in the past is what developed into circuit breakers. So circuit breakers are where the market stops for 15 minutes or an hour or closes for the full day. So traders in computerized program will halt. So that way people have a time to assess what's happening and then make better decisions after the halt is released. So that's why we won't have a day like 1987 anymore, because we have all these trading halts to prevent a total market meltdown in one day, which is a good thing because it gives a pause and it creates some breathing room for traders to think. Now, in 91 was a recession due to economic policy created a recession that created a stock market that went down. But once that cleared up, we had the 90s is one of the best decades for stocks after that early recession cleared up. We did have a currency crisis in the middle of sort of the later half of the decade with the hedge fund long-term capital management being involved. That created some hysteria where the stock prices went down pretty dramatically in a short period of time, but it was what they call a V-shaped recovery. So sort of like this. You see this V here? This is the V-shaped recovery. A U-shaped recovery is when we're talking more like the 2008 stock market crash, or the 2000 stock market crash was more of a U-shape. So that's when the market goes down, trails on the bottom for a bit, and then moves back up. Now, in the case of what's happening now, it could be more of a U-shape stock market based on the fact that the reduced activity, shopping, traveling, diners, restaurants, bars, and the reduced employment because of this could result in a recession. Most likely will be a recession. And then when a recession occurs, we have 2 quarters of declining growth. Now, when the stocks have to release their earnings would typically disappoint, or forecasted guidance will be reduced lower. And that's just more negativity brought into the marketplace that lowers stock prices even more. So in a U-shape decline, you're going to have the initial decline, 30% or so, or 40% of the stock market. And then you can have an additional 10 to 20% decline on top of that as earnings releases come out and disappoint investors, and the overall market is is dragged lower, as we saw in 2008 and in 2000. Now, a V-shaped recovery, this is how we could get a V-shaped recovery. If, say, the pandemic subsides pretty quickly, or a vaccine or a therapy, antiviral therapy is produced pretty quickly and alleviates the fears, and then the lockdown and quarantines and reduced business operations reverse pretty quickly, the stock market could rally back very strongly, very quickly. And that would be a V shape and the best possible outcome that we would want to see. However, it's looking increasingly unlikely that a quick turnaround or solution to this problem will happen that quickly. But if it does, the market could roar back pretty substantially. And in addition, many of the beaten down stocks like Chipotle Mexican Grill and other restaurants will return pretty quickly as customers come back. Now, looking at the long-term view, so let's put like a max view up of the chart here. Okay, so this is going back to 1987 here. So over here, this is the 1987 stock market crash. So, and if you could believe these numbers, the Dow went from about 2,600 down to 1,900. So that's a 25% decline. And you see the RSI here drop significantly. And then, over the long term, here's the 91 recession. You see this little downward motion we went from 2,800 to about 2,400. So the Dow was down here during that 91 recession, and relative strength shows a lot more selling. When the relative strength is low, there's a lot of selling, and when the number is high, there's a lot of buying. So, but you can see how small these blips are. This stock market crash here and a 91 recession, very tiny. And then over here, this must have been the somewhere in back here. Okay, so we see a peak here of about 7,000, and the Dow retreated to about 6,500. This was that quick, I believe this is the currency crisis that was more of a V-shape recovery in the market. Then again, here is the big, this is at 98. This was the currency crisis from 8,300 down to about 78. So we had a nice 1,000-point shaving of the stock market. But you see they never penetrated the 100-day. So the 100-day been a pretty solid support here in these various downturns. It only till we get to 2000 that we have the Dow going down significantly from the dot-com crash, but didn't penetrate the 200. It wasn't until September 11th, when the stock market eventually penetrated the 200-day moving average, and then the 200-day moving average started to creep up above the 50 and 100. Very bad time to be invested. All the way into 2003, stocks were pretty depressed. But in here, between 2003 and 2004 rather, things completely reversed. And when you see, and this is the key to look for, when you see the stock market, the Dow, eventually go above the 50, it's a time to buy. Above the 100, another indicator to buy, and if it actually penetrates the 200 in this situation, it's a real clear market to buy and invest in. You can see that we went from 9,000 to 13,000 pretty quickly, and then we had the 2008 crash, which pretty substantial crash from 14 to 7, almost a 50% decline there. And again, if you followed the Dow below the 50 and 100 and 200, here it's very clear to sell at this point once it hits that 200, and we have that rapid market decline. And this was, again, later reversed until today. Now, so what to look for today, if we see where the market is, if we put up the 1 month, let's do a 3 month. This looks a little bit better. So yeah, we have the classic sign. So if you're using technical analysis, you would have sold your stocks at 27 to 27,000, which would have seemed brilliant today. So what to do now? Technically, you might want to wait until the stock market goes above some of its moving averages to buy in if you're a believer of technical analysis. But it's looking like the fear gauge is all-time high and stocks are lower. So we're bound for another period of volatility. But my personal belief, and I'm not saying that you should trade your stocks on my belief, and remember, this is an educational video only, not advice for what you should do in the stock market. But educationally, I would say that, probably the stock market could take at least 4 to 6 months to find a bottom or settle before momentum can be turned around and stocks can move higher. So this is, of course, can be changed if there's a sudden change in the underlying situation that's happening, either with the economy, with the medical situation. But if that doesn't turn around too quickly, it's going to be more continued, sort of like a negative feedback loop where the negativity comes out and then stocks respond to that. So right now, I think most of the current event negativity is built in. It's going to be the earnings reports that are going to be coming out with revised guidance downward and earnings misses that could propel individual stocks lower. Overall, a really troubling time to invest, but traditional advice would be to dollar cost average at a similar pattern that you typically invest in, say, your 401ks or your retirement accounts. Don't stop your contributions to the market. You want a dollar cost average into this lower market to take advantage of these lower prices, sort of like buying stock on sale. However, I would be weary of anybody putting large chunks of money in right now because, keep in mind we're down 30%, but that could easily turn down 50%. So it's risky and volatile situation right now in the market. So a lot of people aren't quite sure what to do. And that's the confusion and fear that really is troublesome for market prices. And I think what will happen is some stocks will benefit, like Peloton, the at-home exercise company, is benefiting as a lot of gyms are closing, while other stocks that sell food in restaurants are, maybe at some point will be oversold, as if this is a temporary situation and business goes back to normal in a few months, those stocks will certainly come back. So you could look at some stocks that were classically overvalued, such as Spotify. Now here's a article that I contributed to on February 12th. It was talking about Shopify, and in the article they quote me. Basically, they want to know why Shopify's price went up so quickly. And I had said, the catalysts for that were simply they had explosive growth in revenues. They had high per earnings or price to earnings multiples for, that's just was a factor of the fintech sector, which I had stated here, current bubble in the technology, in the financial technology sector. So in this article, I was actually saying, yes, Shopify is in the bubble. And whenever stocks are in a bubble, crazy things can happen, like Shopify going from, only $70 a share a couple of years ago to over $570 a share at the time of this article. So I had stated that, Shopify and this financial transaction stocks were in a bubble. Fast forward just 1 month later, and then we see a company like Shopify. Let me put that up. Hold on. So here's the company Shopify, which does, a payment solution company. And if we see here on February 12th, it was about $531 where an article was published where I had stated Shopify is in the bubble. And just 1 month later, it goes down to about $320. So that was more a pretty good timing of that event. I wasn't really reading any future there. I was just saying that the stock's in a bubble. And typically you don't want to be buying into stocks in a big bubble. Still Shopify at 300 is still a pretty hefty valuation for this company. And you can see over here that the short-term, midterm, and long-term view is all bearish for this. Back on February 12th, this was all bullish. So, when you buy some of these really high flyer companies like Tesla, Shopify, you can see how quickly things can turn around. So sort of like the higher they get, the faster they fall scenario. And these would have been good stocks that if you had the fortitude to short, sell the shares before you buy them, you could have made a lot of money, or at least if you purchased put options on these stocks. But it's a difficult thing to really do. I certainly didn't put any put options or sell the stock short, even though I knew it was in a bubble phase. The only thing I did was not to buy any of it because, any stocks that are really bubbly, I want to stay away from. And this brings us to our last topic for today. The Federal Reserve, cutting interest rates so quickly down to zero. Typically, if we're in a financial crisis, that's a pretty good solution and usually results in pretty good increases in the stock market. And that theory that goes around, you can't fight the Fed. If the Fed's lowering interest rates, buy stocks. But this time's a little different because it's not so much a financial crisis, although it looks like it's turning into one. It's more of a medical crisis. So I'm not sure, the Fed's actions are reassuring, but we're really not going to get out of this recessionary downward economic trend until this crisis is over. But let me just leave you on a more positive note. If you look at let's go back to the Dow. Let's see here. Actually, the Dow is up 2% today, which is good. We like that. Okay, so if let's look at the max view of the Dow. Okay, so here's the maximum view of the Dow. And we see, in every 10-year span, the Dow has done better than the previous, ended higher than where it started in 10 years. And if you look at the long-term trend of the Dow here, and this will only go back to 85. It's primarily upwards. So we do have moments of volatility, which makes sense because that's why you have higher returns in stocks, because you have higher risks. So whether you measure them by the capital asset pricing model or beta, you have these higher risks in the stock market. And you have to be able to endure these downward trends of the stock market to really appreciate the upward trends. So market timing is really not something I ever recommend to anybody because very few people have ever gotten that right more than once. So market timing is a really tricky thing to do. So that's why I do believe that for the average investor, just a continuous and constant and steady amount of investing over a lifetime will result into much higher returns in the long term. So when the stock market is high, you're putting the same amount of money in, you're buying less shares, and when the stock market is low like it is today, you're putting the same amount of money in every month and buying more shares at a lower price. And over time, that equals out. And if you have patience, you will do well. So I'm going to leave you with that positive note, and I hope that this educational video that's tied to my courses helps you to understand what's happening in the markets a little bit more, since you're finance concentration students and you're studying the market. I thought you might find my perspective of it a little interesting. Everyone, I hope you stay safe and be well, and let's hope for a quick solution to this current events. Thank you.